Welcome. Today we are going to discuss about the preparation of the cash flow statement, which is a pretty important financial statement for every business organization and more specifically for company form of business organization. As a part of the company financial statement, cash flow is one of them. So there are 5 statements which are included in company's financial statement, like income statement, our balance sheet, cash flow statement, statement of changes in equity, and notes to accounts. So these are all 5 statements which a company mandatorily prepares for its users or stakeholders or investors. Cash flow statement is pretty much important. And why it is important? It is going to tell us how the company or business organization generate cash, which are the sources the organization generate cash and where it uses the cash. So cash flow statement tells us the sources of generation of cash and cash equivalent. We will see what is a cash and what is a cash equivalent just in a moment. But yeah, the statement tells us, cash flow statement, it tells us that the sources of generation of cash and cash equivalent. See, I'm writing in short, cash equivalent, and the uses of cash and cash equivalent. So this statement tells us that where from we are getting the cash and where we are using the cash. That is also pretty much important for the investors. And in this regard, the investors can analyze better about the company's performance. If the company is really generating good cash from its revenue or from its operation, it's a very fantastic for the company because the company is operating well. And if you see the company is spending good amount of money on creating new assets or creating new investment, that is also very encouraging for the investors' point of view, because they see companies trying to expand in the coming years. The company will be making more profits. The company will be growing. Company will be making more returns. So these are the things the company, basically try to showcase to the investors and stakeholders. And it is really benefit also the investors. So in this regard, first of all, we will understand the basic terms which we use in preparation of the cash flow statement. So here we have what is a cash flow statement. Cash flow statement is one of the financial reports in the financial statement, which shows basically the flow of cash and cash equivalents during a period. That is basically one accounting year or 1 year, one reporting period. So here cash flow statement is telling us the flow of cash and cash equivalent, and the flow can be both inflow and outflow, in and out. Inflow basically when the business receives cash, that is inflow for business, and when the business pays cash, that is a outflow for business. And here also the cash flow is defined as inflow, the received, outflow as payment. What is a cash? Generally we mean cash as cash in hand and cash in bank or deposits with the bank. Cash equivalents are little different from exactly cash. The way it is basically considered as a near cash, or kind of, which is very easily convertible to cash, something very easily convertible to cash. So these are basically our assets which can be very easily or very readily convertible to cash without loss of time. The moment you want, you can convert them into cash. So these things can be basically our investments, and these investments are very liquid, highly liquid investments, short-term investments. Yeah. And there is another characteristic of this cash equivalent, which you say them basically they are your short-term investment, that when it comes to their value, the amount which you invested in this short-term investment, the value would not be changing too much. The value is not subject to too much of change. So therefore, there is a very insignificant risk of change in their value. For example, if you are investing 100 rupees in that investment, there is a very less risk that the investment would be sold out at a price which is different than 100, and more particularly less than 100. If you sell at less than 100, then there is a risk of losing value, losing wealth. So this sort of investment cannot be our cash equivalent. So cash equivalents are those very reliable investments, short-term investment, highly liquid investment, where we can park our money for short period of time. We may get very low return. Okay, that is okay to us. Just keeping money in terms of cash absolutely gives us no return. But yes, if we can park money in this investment, at least some return would get. Maybe that is very low, but yes, we are getting something. So therefore, we park money in this short-term investment, and as and when we require the fund, we can convert this investment to cash. But there is very insignificant risk attached to loss of the value of these investments. That is another criteria. So there must be short-term highly liquid investment, and there must be very less risk attached to them with regard to loss of their value. And yeah, there is also a time frame which we use to judge an investment whether it be qualifying as a cash equivalent. The time frame is 3 months. 3 months or less, that is 90 days or less. If you are investing in any investment and you are planning that you may convert it within 90 days or 3 months, that is, maybe that is a cash equivalent, or that you may consider as a cash equivalent, provided other condition like a very insignificant risk must be, attached to this investment. Yeah. So this is a cash equivalent, we understood. Then other definitions or other terminologies important in this particular statement are the activities. See, as we saw, cash flow statement tells us the flow of cash, inflow, outflow of cash. So for a sake of better understanding, we have divided the flows into 3 activities. Which activities these flows are basically happening to the business? So these 3 major activities of business, we call them as operating activity, investing activities, and financing activity. So we always see cash flow with regard to these 3 activities, because these 3 are the major activities which every business they perform. Every business first finance, take the loans and equity from the investors. They invest in assets, they create assets, and then they operate those assets to make revenue. So these are the 3 activities every business they undertake. So therefore, we see that how business is generating and using cash in these 3 activities separately. So individually, we will see how much the business is generating and using cash in operating activity, likewise in how much the business is generating or using in investing, and how much the business is generating and using in financing activities. And what are these activities? Already we have discussed. Operating is running the business, activities pertaining to running business. Investing is basically activities pertaining to creating assets, basically buying fixed assets or long-term assets, or selling, disposing these fixed assets or long-term assets. Financing is basically raising finance or repayment of finance. So inflows and outflows would be classified the nature of the activity. So here we will see in the format that there are separate inflows and outflows in these three activities presented. Then there is another thing which we see also in the cash flow statement, extraordinary activities or extraordinary items. Generally, we evaluate a business based on their standard, regular, ordinary operation. So how the business is generating fund from their standard, general, ordinary business operations. Maybe in these three activities, but yes, there are certain cases business may incur certain abnormal losses or abnormal profits. So those things also affect the cash inflow or outflow of business. That also we showcase in the cash flow statement so that any viewer or any user or any investor who is looking into our cash flow statement can figure out the effect of these rare, abnormal, extraordinary items. These are non-normal items. These are abnormal items. But yes, they are occurring, maybe in terms of profit losses. We also disclose them clearly so that one can figure out that how much is the effect of this abnormal or extraordinary item on the cash flow. So after understanding these basic things, basic terminologies, let us get into the formats of the cash flow statement. Before we discuss the format, also I would like to tell where the cash flow statement is getting its like its format or its origin, or which particular rule, regulation, or standard that is prescribing to prepare the cash flow statement, the manner it is getting prepared. So as we know, there is a schedule 3. Schedule 3 Schedule 3 which prescribes for the formats of income statement plus balance sheet. So when we prepare income statement or balance sheet, we refer to the formats prescribed in the schedule 3. That is no, and schedule 3, I believe we all know that schedule 3 is belonging to the Companies Act. Companies Act 2013. So that is the Companies Act in the schedule 3 is prescribing format for the preparation of income statement and balance sheet. But there is no such prescription in the Companies Act as to how do we prepare the format or any guideline about preparation of the cash flow statement. So therefore, where we are getting that guideline, that I believe, preparation process to prepare this cash flow statement. Yes, that is a guidelines also, but it is not in the Companies Act 2013. And that guideline basically, if I tell you, some guideline like this cash flow statement guidelines, some are basically coming from, there is an accounting standard 3, which is basically old set of accounting standards which we have, and these accounting standard also still valid, but this is applicable to smaller companies. And now for bigger companies, we have Indian Accounting Standard IND-AS, and IND-AS 7 also very synonymous to Accounting Standard 3. But Accounting Standard 3 is applicable to smaller companies, and Indian Accounting Standard 7, which is also same cash flow statement, but it is applicable to bigger companies. Basically, what I mean by bigger companies, when our net worth, any companies, its net worth is greater than 250 crore. So rupees 250 crore, if net worth of the company is, then that we may consider as a bigger company. So to them, it is mandatory to apply the Indian accounting standard. And when we look at Indian accounting standard, it is IND AS-7, that is the cash flow statement. But old accounting standard, it is accounting standard 3. Same, both are cash flow statements. And also in case of listed company, irrespective of what is your net worth, listed companies, irrespective of what is your net worth, this also Indian accounting standard 7 is applicable. So now we got to know that there is a standard in accounting standards, which is IND AS-7 in Indian accounting standard framework and old accounting standard framework. It is AS-3, accounting standard 3. They provide the format, rule, regulation about how to prepare the cash flow statement. After understanding this, let us little also discuss about the methods, the standard they prescribe. If I mention here, there are two methods prescribed by the standard, both the standards. So if I say Indian accounting standard, IND AS or AS, both, they provide for two methods. One is a direct method and another is indirect method. Both methods are valid methods, and the company, they may follow any method. But yes, if you ask me which the standard basically tell to follow, the standard tells to follow direct method. Standard encourages to follow this direct method. But yes, you can also follow indirect method. Absolutely no issue with it. And if you ask me what generally the companies they follow, the companies they follow indirect method. Direct method is little straightforward, which requires the company to disclose about its cash revenue and cash expenses, which the company may think like little, direct about disclosing certain private information to the outside world. So the company, therefore, they follow indirect method, where basically in indirect method we adjust the profit. In indirect method we adjust the profit. So little if I elaborate what is the difference here. In the direct method, as I was telling you, this is encouraged. In the direct method, it is basically the operating activity, which is calculated differently in these two, direct and indirect method. Only operating activity. Both investing and financing activities are same in both the case. Direct method or be it indirect method, investing and financing is same. But when it comes to our operating activity, so the calculation is little different, which I'm telling you now. So this direct and indirect method is only different with regard to operating activity. But financing, investing, both the method we follow the same way. So here in direct method in operating activity, remember we are telling just the difference in operating activity, because that is the activity where we find the difference. Other two activities we report absolutely similar fashion. So in that method, we calculate operating cash flow very simple and straightforward manner, that is cash revenue what we have received in cash minus cash expenses. So we get operating cash flow. Yeah, we can adjust for income taxes or we can adjust for extraordinary item. But yes, the approach is this, very direct. How much you received your income in terms of cash, how much you paid your expenses in terms of cash, you get the cash flow from operation, and always the net cash flow would be after adjustment of the taxes, how much taxes we have paid. If you have not included taxes in your cash expense, so you can minus after getting operating cash flow before taxes, then you minus taxes, you can get operating cash flow, which is after tax or the operating cash flow. That is the case. So this is straight cash received from revenue, and then cash paid for business expenses, the difference we are taking. But when it comes to indirect method, I'll tell you what is the thing. Here in indirect method, we do not go this straightaway format. We go by just adjusting the accrual profit. To arrive at cash profit. We adjust accrual profit to arrive at the cash profit, and this cash profit is nothing but operating activity cash flow. This is equal to operating activity cash flow. So therefore it is called as indirect method because we go indirectly. Something net is basically how much we receive, how much we pay. The difference is the net flow. But here we are not just doing that. Rather, we are arriving at the net cash flow from the operating activity indirectly by adjusting our accrual profit. And what is accrual profit? Basically, this profit we get from income statement. Income statement gives us the profit as per accrual basis of accounting. So that income statement profit we take, we adjust for certain items, and then we arrive at the cash profit, which we call it as basically operating activity cash flow. So operating activity cash flow is calculated in indirect method by adjusting the income statement accrual profit. So these two methods, as I mentioned, they are only different with regard to operating activity. Both financing and investing activity cash flows, the way we prepare for direct method, exactly similar way we prepare for indirect method. But as I told you, companies, they follow indirect method to prepare the cash flow statement. So now let us get into what the accounting standards they prescribe as to the format of the cash flow statement. So here we have cash flow statement format in the indirect method. I will just take you so within the three activities, and then towards the end of the video, we would also solve an illustration on how to prepare. See here, the starting point of the cash flow statement would be our operating activity. This is the first activity we start with. And this operating activity also start with net profit before tax and extraordinary item. That is the starting point of operating activity. If you are not having extraordinary items, simply you can take net profit before tax. But if it is not given to us, maybe if I refer to questions in the exam which we solve, certain cases net profit before tax extraordinary item, that is not provided to us. But if you see practically, if you refer income statement of our company, therefrom we can get easily net profit before tax in the income statement. But maybe exam question, that is not very straightforward way provided to the student, so you may be calculating it in working notes. Okay, how do we arrive at that also I'll tell you. But let us understand the format, and other working notes I'll be telling. So net profit before tax and extraordinary item at the starting point. Then what do? We will adjust for non-cash, non-operating items. Non-cash items are those items where they are put in the income statement, maybe as an expense or as an income, but they do not result any inflow or outflow for the business. For example, depreciation. Depreciation is an expense in the income statement, and It is minus from the revenue to arrive at the profit. But like other expenses, be it salary or rent, as they result cash outflows, but depreciation, similar expense or loss will not result in any cash outflow. So this is a non-cash item. So when we are converting our actual profit, which is net profit before tax, to cash profit, so those non-cash items which are minus to arrive at this net profit before tax in the income statement should be now their effect will be reversed, because depreciation was minus there, but it is not a cash payment. It is not a cash expense. So when we convert this accrual profit to cash profit, so those non-cash expenses, their effect would be reversed because they have not resulted in any payment of cash, but we minus them. So now when you come to cash profit, so we have to add them back. So those things which are basically minus in income statement, be it non-cash like depreciation or non-operating like our payment of interest on borrowings. Basically they are financing activity because borrowings are financing activity and interest component on those borrowings are basically financing activity items. So those are also non-operating activity item. They will be added back because they are minus in the income statement. Now we are reversing their effect. So items to be added, basically non-cash items which are minus in the income statement, or non-operating item like interest on borrowings which are also minus in the income. So all minuses which you want to nullify their effect, be it non-cash or be it non-operating, we are adding them back. So here we are adding those non-cash, non-operating, those are minus in the income statement. Likewise, we will add those. So this is added. Now we have added the non-cash, non-operating item which are minus in the income statement. Now we will minus or less those items which are added in the income statement. We will nullify their effect here by minusing them because we want cash flow from operating activity. So those non-cash items, their effect, or non-operating item, their effect would be nullified by reversing them. So these items are added in the income statement, be it our interest income or dividend income. Basically these three are investing activity incomes. If you have financial assets like debentures, bonds as investment, or securities like equity shares as your investment, so you receive interest or dividend on them. If you have real estate asset like land building, we receive rental income on them. So these are these assets which I talked about, their investment, and the income pertaining to them are investing activity inflows. But when we prepare income statement, we add them all in our other income. So they are included in our other income, but we want to know what is operating activity income. So these non-operating activity incomes and inflows, they have to be adjusted. So we minus because they are added in income statement. Now we are nullifying by minusing them. Likewise, there is a non-cash, if at all any non-cash, non-operating item, any other thing we have as a loss or as an income. So we will be all adjusting them. So these are the items which are to be added. Basically, they are losses or expenses, maybe non-cash, non-operating character, and the item to be minus or less in this format is basically incomes, non-cash and non-operating incomes. So after, like here, we also adjustment for gains or gains on fixed assets. So these are incomes which will be adjusted in the operating activity to nullify the effect because they belong to investing activity. So once we adjust the non-cash, non-operating activity effect, so we will be arriving at operating profit before working capital changes. So this operating profit before working capital changes is arrived at net profit before tax and extraordinary item adjusted for non-cash, non-operating items. Some are added, some are minus. So once we arrive at this operating profit before working capital changes, so we'll be adjusting for working capital changes. And working capital changes are nothing but change in the current asset and current liability, how they are impacting our flow of cash. Basically, there is a understanding which is very clear. I believe we have understood in our, you know, in our studies that if current asset increases, it basically absorbs the part of working capital. If you see, the working capital consists of three items. Basically, in a business, at least three items would be consisting are, working capital. For example, cash, stock, and data. If you're not taking any credit, so it is stock, cash, and data. So first we have stock. First we have cash. We converted cash to stock by buying stock. Then we sold the stock to the customer. It became data, and again data pays become cash. Again, cash we can buy stock. Then stock we sell to data. Then data would be realized to cash. So this is how these current assets, they are changing their shape. They are changing their, their nature. Like they are cash one time, other time they're becoming stock, then next time they're becoming data, then again converting to so this is how they're changing their shape. So what we understood from this, if we have cash and we are buying stocks, that means what? When stock is coming or increasing, it is absorbing cash. But when when stock becomes data, also data, we are not getting any cash. But when data reduces, it becomes again cash. So therefore, if any current asset which is other than cash is increasing, basically it is absorbing cash. By absorbing cash, it is increasing. So increasing current asset, it is a absorbing effect on cash. So it uses cash. So it is an outflow of cash. So it's a negative effect on cash. So it is an outflow of cash. Likewise, if you see it is a decrease in current asset, likewise it will be inflow of cash. So this is for current asset. So this is the rule. If current asset increases, it is cash outflow minus, and if it is current asset decrease, it is a cash inflow plus. Likewise for current liability, the opposite rule. Current liability increases, it will be giving us cash. Plus, current liability decreases, it is absorbing or using cash minus. So this way we will do for all current asset, current liability, barring couple of asset liability like cash and bank. We will not take cash and cash equivalent. Will not take. So when we take current asset, current liability changes, we will exclude couple of assets like cash, bank, and cash equivalent. Also tax liabilities, tax provisions, because tax provision is separately dealt with. So minimum these two things, current asset, current liability, we will exclude, because cash is naturally excluded, because we are seeing the effect of other assets, rest of the assets apart from cash, how they are impacting cash, how cash is generated during the year from other assets, and how opening cash changed to closing cash. And then tax provision, tax effect on operating activity is separately dealt. So therefore, we are also excluding in the current liability the tax provision. So barring these two assets and liability, we will see what is the change of other asset, and we will give their effect in the cash flow from operating activity. For example, inventory or stock decrease, it will be added. These are all non-bracketed figures. So these are all additions. Decrease in trade receivable, like this is also a current asset data that is reduced. Decrease in accrual. So all these are assets and they decrease. So asset decrease, current asset decrease, they are to be added. Current asset decrease, yes. And if we asset decrease, and also there is an increase in the current liability, trade payable and all. So they are also their effect, trade payable, upfront expenses, advance incomes. So current liability increases, they are also to be added, as we understood. Then the opposite for the increase in the current assets and decrease in the current liability. So here increase in the current asset will be having minus effect, minus, less, they are minus, and here they are added. Here they are added, or increasing effect on the cash and cash equivalent. It comes from decrease in the current asset and increase in current liability, which we add them all because they increase the flow of cash. And those effects which are reducing the cash flow, so we minus them, less. So what are that? What are those? Those are basically decrease in the foreign liability and increase in the current asset. So this is how increase in current asset and decrease in current liability. So their effect is reducing cash flow, or they are considered to be cash outflows. They are minus. So now after we adjust for current asset, current liability, or working capital changes, we get cash generated from operations. And then we have two more items to adjust. One is tax paid. The tax paid we will be considering basically after adjustment of refund. If at all we have received any refund during the year, so that is a tax return back to the assessee or the business. So tax which we paid and some amount of tax we also may get refund from the income tax department, that will be netted off. So we will get net tax paid. Net tax paid. That will be minus. And then extraordinary cash flows. If you have extraordinary profit or income, so that will be received to you as a cash inflow. So you add it. So here after the tax paid, you get basically cash flow from your normal operating activity, ordinary operating activity. But in certain cases, you may get some extra cash flow from some abnormal gains, or you may pay some cash in certain abnormal losses. So those things, if you adjust the net flow in the operating activity, both from ordinary and not ordinary activity or extraordinary activity. So here after tax, we are getting cash flow from ordinary activity. Now you're adjusting for extraordinary item. If it is a profit, you add it because it is an inflow. If it is a loss, you minus it. So extraordinary item, profit, we added. Loss, basically, you pay or you suffer outflow, that will be minus. Then you get this operating cash flow. So cash flow from operating activities. So this is the really tricky part of the cash flow statement preparation. In the indirect method, we adjust our profit before tax and extraordinary item to arrive at the operating activity cash flow. And then when it comes to investing and financing, they are easy to understand because the inflow and outflow quite easily figured out. Because see, in investing activity, generally, if we try to understand simply, we can say all those activities pertaining to our non-current asset of the balance sheet, NCA, non-current asset of the balance sheet. So any transaction pertaining to non-current asset part of the balance sheet would be our investing activity item. So non-current assets, long-term assets, if we buy them, we'll be paying cash, so that is cash outflow. If we sell them, that is inflow cash. And also non-current assets, certain cases become our investments, like investment in securities and real estate assets like land building. They're also assets, and they certain time give us returns like interest, dividend, and rental incomes. Those are also our investing activity flows, and they are inflows. So all in all, there are three variety of cash flow in this investing. One is purchase of asset, basically I'm telling non-current asset. Other one, sale of assets, that is inflow, non-current activity. This is sale is basically inflow, but purchase is outflow. And that is the third one, incomes. Pertaining to certain cases, assets are some sort of investments, be it financial investments or real estate like land building investment. So these are the three activities you may get. So purchase, as I told you, this is outflow or negative flow. This is sell is inflow, because you sell asset, you get cash. Incomes are also inflows. You get rent or interest or dividend. So these are the three variety of flows you may have. And two are inflows and one purchase of assets are out. So we see proceeds from sale of fixed assets, proceeds from sale of investments, proceeds sale of intangible assets, any dividend received, rent received. So all these are our inflows. These are all non-bracketed figures. And the bracketed figures like purchases, you see. Purchase of non-current assets, long-term assets, they're outflow, and they are negative figures, bracketed figures. And we add all the figures, all the flows, be it inflow or outflow, we get net cash flow. So here net cash flow is written as cash flow from investing activities, and we know if it is a positive figure, positive, like the net, we are getting a positive figure, it is basically, we call it as cash flow from investing activity. But if it is a negative figure, we tend to say cash used in investing activity. If it is, let's say 5,000, so we write cash flow from investing activity 5,000. But it is minus 5,000, we say cash used in investing activity minus 5,000. So that is how it is read as. So investing, then financing activity, there it is also easy to understand like investing. So what here we see is basically what are the flows pertaining to the financing part of the business. And when we look at financing, it is basically our equity, that is equity capital, that is the finance. Business is getting finance with raising capital, equity capital, plus our non-current liability. So these two are the sources of finance for business. And you may say where the reserve surplus should be placed. Reserves and surplus are out of the operating profit. So they are dealt in the operating profit. So here financing activity, basically we can relate to the equity and capital part of the balance sheet, or non-current liability part of the balance sheet. The changes in these items in the balance sheet, they give rise to financing activity. So how do we explain now? Here equity and non-current liability, if they are issued. So if I little further explain, if they are issued, so you get cash, it is inflow or plus positive cash flow. But if you redeem or repay or you buy back, like buybacking of equity share, okay, so there you get outflow, or it, you purchase or redeem, you can say redeem those shares or debentures or loans, or repay. In that case, it is outflow minus negative cash flow. And also with regard to this principal financing, we have to pay annual or regular cost of capital, which we call them as interest, cost of finance. So cost of finances are basically our expenses. They are our interest and dividends. So interest and dividends are outflows. We pay them. So therefore, they are outflows. So all in all, we got equity capital or non-current liability like loan, debenture, bonds, any advances we are taking. So those are all sources of finance. If we issue, then we are getting flow of fund. And if we repay, that is outflow. And along with, we pay annual or some quarterly or half yearly interest or dividend. So those are also outflows in the financing activity. So now if we see here, proceeds from issue of shares, proceeds from long-term borrowings. So all these are our financing activity. And also repayment. If you see repayment of loans, redemption of debentures, all these are repayment of loans and liabilities, and they are outflows. And also our interest and dividend, interim dividend or proposed dividend, all these are dividends which we are paying. These are cost of capital. They are also outflows. Proposed means final dividend we are paying. They're all outflows. Payment of interest also outflows. So their cost of capital, they are outflows and they are having negative cash flow effect. That is something I would like to also tell. Certain cases we may get we may come across bank OD, bank overdraft. I consider bank OD is a negative bank balance. So if you include in the cash and cash equivalent, if bank is included in cash and cash equivalent, negative bank balance, which we call it as OD, is a cash and cash equivalent but negative, because this is not a source of fund. For example, like it is not a financing. We are not borrowing to make use of it. Certain cases, when we are making our payments from bank, we withdraw more than what we have deposited. So it is a temporary period. Our balance is negative in the bank. So that is a still our bank balance, but negative, I would understand. But certain authors, they consider bank balance is a, when it is OD or negative, it is a sources of fund. It's a financing activity stuff. So that is a bank OD and cash credit. If we are having increasing, so in that case, it is a sources of fund for us. But I generally consider bank OD is a cash and cash equivalent part, and we take it negative. Like when we arrive at here, let's say arriving at opening cash and cash equivalent. So here we are summing up many things like cash and cash in hand, cash in bank, short-term investments and all. All these are positive cash and cash equivalent, but bank OD, if you have, it will be negative. So less bank OD. And also here, when we arrive at the closing, there are also less bank OD. Add all this and minus bank OD so that we will get net cash and cash equivalent at the closing, at the opening. That is my approach when I consider bank OD as a cash and cash equivalent but negative balance. Certain authors, they see bank OD as a financing activity item, so they take in financing activity as a sources of fund or as a sources of cash. So that is there. We understood financing activity, equity and non-current liability, and issue is basically inflow plus, and redeem is basically outflow and minus. And cost of finance, interest, dividend, and all these are outflows. So once we add all these inflows and outflow in financing activity, what we get? We get similarly the cash flow from or used in financing activity. So it may be, if it is positive, it is flow, it is negative, it is used in financing activity. Now I will tell by default or what should be, what is the ideal situation, the ideal kind of flow in these three activities. So operating activity, when we come, basically we are referring this operating activity cash flow as a profit. This is our cash profit, we are saying. Operating activity cash flow is basically our cash profit. So when we say cash profit, means what? It must be positive. So we are having surplus cash from our revenue after payment of all expenses. We have very nicely and very comfortably met all our cash expenses. Wherever there is a payment of cash in our day-to-day running of business, we have paid it very easily out of our revenue, out of our income, and still we have surplus cash. That is what? Cash profit. And that is operating cash flow. So a business should be showing operating cash flow as positive cash flow to be healthy. Like it must be having positive net cash flow from operating activity. Unless and until it is having, it can be considered as healthy, because we must be always seeing business must be able to generate adequate cash to pay its day-to-day expenses. And after that, it generates some surplus cash for for its owners and investors out of its operation. So operating cash flow should be always positive. That is what we expect, and that should be. For investing activity, what is the ideal situation? For investing activity, it should be, if investing is little above here. Investing activity cash flow should be, generally it becomes negative because many assets, they require replacement. And when you sell some asset, because here it is sale and buy of asset, uncertain incomes, and incomes put into investment. So when we sell asset, generally these are old assets, taken out of use. So the money which we get from them, generally they are very negligible and less scrap values we get. So sale of assets we get very less, because these assets are meant for use, and when they are taken out of use, they are sold. So amount you realize by selling those assets are very less. But when an asset will be replaced, you have to buy a new asset. You have to pay absolutely huge amount for buying new assets. And also when you go for business expansion, there also you have to make new investment and buy more assets. That also requires outflow. So buying new assets for replacement in business and in expansion requires huge outflow, but the inflow when you sell, generally that is negligible, because these are old assets sold out. So therefore, here generally it is also a good sign to consider for business. It is not a bad sign. It's a good sign. It is not looked at negatively, or in a negative manner. It is not considered. It is positive if you are getting a negative cash flow. Negative cash flow in investing activity is good sign. So generally in good businesses, you find the cash flow from this one investing activity is negative. Financing activity depends. If you are, let's say, expanding your business, you are taking more loans, so obviously you'll be taking more finances. So it may be a positive cash flow. If you are repaying your loans, you're having sufficient cash, surplus cash and all, you're repaying your business. So business sources of finances, loans or capital, that is there you get outflow. But yes, a business, if taking loans and all, it will be considered as expansion. So if you get positive cash flow, that is business is expanding, because business is taking, if it is positive, business is taking more finance for expanding its operation. But if business is repaying, so you get negative cash flow, repaying loan. So it is a sign that business has already expanded and reached to a maturity level. The business is matured. So now the profit it is getting, now operating profit and all operating surplus cashes it is getting. So it is now using it to repay its loans or repay its capital. So that is how it is read as. Basically, when business saturate, you basically repay your loans and capital. So that is another analysis you can make out of it. So these are the analysis of the cash flow, and once we add the three activities net cash flow, we get net increase and decrease in cash and cash equivalent. So this net increase and decrease in cash equivalent, if we add to opening cash and equivalent, opening cash and cash equivalent, this which consists of cash in hand, cash in bank, short term investments and all, which we call them as cash equivalent. Okay, so this is basically change in cash and cash equivalent added with opening balance of the cash plus opening cash and cash equivalent. Basically what we do, we arrive at closing cash and cash equivalent. Yes. So this closing cash equivalent must be matching with your balance sheet cash equivalent, and opening cash equivalent must be matching with the comparative last year balance sheet cash and cash equivalent. And this is what we will get in the current year, how much extra cash we have generated or change in the cash and cash equivalent during the year from all the three activities. Individually also, from individual activity we are getting how much cash we have generated and how much cash we have used. So this is the format of cash flow statement in the indirect method. As I told you, there are two methods. So generally companies, they prepare in indirect method. I explained you thoroughly the formats. And now it is the time for understanding when we are not provided with the net profit before tax and extraordinary item, which is the starting point to prepare operating activity cash flow. So this is the working note we have to do. So basically our profit, when it is going up to like it is due for taxes, or it is now, let's say before tax we are having, let's say we are saying it is PBT. So when it is going for distribution after PBT, the first comes is the tax you pay. So we get PAT. Now this PAT is not like kept as just PAT in our balance sheet or so. It gets distributed or used in different manner. For example, first we may pay, let's say, dividend, and dividend can be interim dividend or annual or final dividend, which we call proposed dividend. And generally every year we pay the final dividend for the last year. Basically this every year whenever you pay the dividend, that is the final dividend of last year, because last year proposed dividend is current year it is paid, and interim dividend of the current year. Current year interim dividend we pay in the current year, and last year final dividend or proposed dividend we pay in the current year. So dividend we use out of the PAT. Then rest PAT we may transfer to certain cases, certain statutory and other reserves. So next comes is transfer to reserves. So rest of the PAT is used for transferring to reserve. First we pay dividend, then rest, some amount out of the rest we are transferring to reserve. Certain cases transfer to reserves are mandatory, and certain cases you also transfer to reserve for future expansion, growth and safety. If at all there is any remaining PAT that may be lying in our statement of profit loss or in the surplus. So if last year's surplus is given and the current year surplus given, so the increase in the surplus, last year, let's say the surplus or the statement of profit loss position was 50, surplus balance last year, closing balance was 50. Let's say current year it becomes 70. When you are seeing your closing balance, it becomes 70. How? 20 rupees of profit, which is PAT, is a transfer. This is basically current year profit. Current year profit. So out of the current year PAT, some 20 is transferred to the surplus, or you can say retained earnings, which was last year 50. Now current year the closing balance is showing the balance sheet as 70. It goes up to 70 because 20 is transferred from the PAT. Likewise, some amount is transferred to reserve. So likewise, we can see it from the balance sheet as if last year reserve was, let's say, 90. Last year, the closing balance of reserve in the balance sheet was 90. Now it is 120. The closing balance of reserve in the current year balance sheet. Obviously, the increase is because of transfer from the current year PAT. 30 rupees is basically getting transferred from the PAT. And dividend, if it is distributed, for example, some interim dividend of 10 and final dividend of 20 for the last year, which basically I told you, final dividend which you pay is last year dividend. So 50, 10, totally 60 rupees of dividend, and 30 rupees transfer to reserve, and 20 is in the increase in the surplus. So now you see, if I ask what is the total PAT for the year, simply we will piece them together. This PAT which is distributed or divided, now we piece them together, we get the PAT. So what are the things we piece together? This 20 as a surplus, 30 as a transfer to reserve, and 60 as a dividend. So how much it will be? 20, 30, 50 and 60. 110 becomes our PAT. But we have to start from PBT. So I am explaining you where to get PBT. And I am explaining you where to get PBT by explaining that how PBT is getting distributed down the line. So PBT is first used to pay tax, then we get PAT. PAT is distributed like this. So I piece together the distribution of PAT to get the PAT, then the tax which is there, your tax expense of the year, tax provision that we had. Let's say tax provision is 40 rupees for the year. This tax provision. So that we add, we get profit before tax, let's say 150. This is 110. As I told you, PAT is 110 here. 14 rupees of tax provision. Then we get PBT is 150. And that we want. And if we do not have any extraordinary item, so we will start from the PBT. But if there is any extraordinary item, let's say, so obviously your extraordinary item must have been adjusted in the profits, your PBT and PAT also, because it gets adjusted from, and it gets adjusted in the incomes or expenses. Extraordinary income you show in the other income, extraordinary losses, expenses you show in other expense. So they're already adjusted when you calculate your PBT. So in the cash flow statement, if it is required to calculate profit before tax and also extraordinary items, so we have to also nullify their effect. What do we do? If it is extraordinary item is a profit, it must have been added to the income to get the profit. So we now minus it. So minus extraordinary profit. This is minus to be extraordinary profit to be minused out. But if it is a extraordinary loss, that must have been minus from the profit. Now you nullify the effect, you add it. So extraordinary losses will be added to nullify the effect, because we want before these items what is the profit. So if it is profit, it was added, now we nullify by minusing. If it is a loss, it was minus, now we are nullifying the effect with adding. So then we will get extraordinary item. Effect is factored in the profit. So we arrive at net profit before tax and extraordinary item. And if we arrive at or if we use a format kind of thing or a statement kind of thing to arrive at this, see, we will take the difference in the surplus, like I taken opening and closing difference in the surplus. So that is the starting point. Here I taken 70 minus 50, like 20. That is the starting point. Then we will add transfer to reserve. That also we can take the opening and closing difference. We will get how much is transferred from the current year profit to reserve. That we add. Then dividends, interim dividend or proposed dividend of the last year, which we call final dividend of the last year. Then provision for tax also we add, because we are piecing together after tax profit distributed plus also the tax expense minus. So tax effect is to be added back because we want PBT. So we are adding back tax effect. Then extraordinary item, if it is loss debited, now we are adding back. If it is profit, will be minus. But certain cases we are also we have to adjust refund of taxes with a provision for taxes. So this refund that reduces our provision. So we can minus from the provision for tax this refund, or we can separately put it here. If you are not minusing here from the provision for tax, we will minus it separately. So then we will get net profit before tax and extraordinary item. If it is not provided, we have to do its working note and we will arrive at this. So we have understood that couple of working notes are required and couple of special items also to be considered. So when we venture into preparation of the cash flow statement, I will tell you what are the things you need to have in your hand. Certain things you can easily figure out and certain things require some sort of calculation which you do in the working note. So generally what is provided to us? If I tell you, provided is basically 2 years balance sheet with notes. I'm talking about exam question perspective. So 2 years balance sheet plus notes to accounts is provided to us. Also, certain cases we have been provided with some additional information. Additionally, for example, if there is a change in your loan figure or debenture figure. Debenture was 1 lakh, now at the end of the year it was 2 lakh. So there is 1 lakh increase, but when that is increased in the debenture, because there is an interest effect. An interest will be calculated based on for what period the debenture was used in the year. So when those things are missing, it is difficult to figure out what is the interest amount of the debt. So therefore, the question may provide, yes, this debenture were issued on such and such debt. So it is easy for us to use those information to calculate the interest, and also additional informations are provided to us. So 2 years balance sheet, consecutive 2 years balance sheet, notes to account, certain cases, certain detail of any item in balance sheet required, that is given in the notes, and some additional information. With these things, so we also require to calculate beforehand certain things, certain amounts which we need in cash flow statement. So those are little special items which you need to figure out. What are these items? I'll mention here couple of items. Number one, our dividends, because these dividends, as I told you, they are required to calculate net profit before taxes and extraordinary item, plus dividends are cash flow, basically they are outflows in financing activity. So these dividends you need to be first getting if they are there. Number one, like your final or proposed dividend, or proposed one, basically proposed dividend of the last year. Proposed dividend last year. Current year dividend only declared, not paid. So last year dividend is paid. So that is an outflow. Then number two, interim dividend. Number three, certain cases we have to look into depreciation. Depreciation, if it is given to us, then as a matter of additional information, it is okay. Otherwise, we will calculate. There is a formula which you can use simply. That is our opening balance minus closing balance equal to depreciation. Here, in this particular case, we will assume that there is no buy or sell of asset, fall in the value of asset. Closing is less than opening, so the fall in the value of asset is depreciation only. But if at all there is a buy or sell of asset, so depreciation again must have been given to us. If it is not given, but opening and closing value of our assets, fixed assets on which we charge depreciation, they are not same. Opening is different from closing. In that case, we'll assume the fall in the asset is basically closing balance is less than opening is basically because of depreciation for the year. Simply we'll take that. But yes, the buy or sell of asset, there must be depreciation provided, and we will use the equation like this. Opening, when depreciation is provided to us. So now opening balance of asset minus depreciation plus purchase of asset, or minus sale asset equal to closing balance of asset. This is the equation we will use. So when depreciation is given to us, opening balance sheet would tell us opening balance of asset, closing balance sheet would tell closing balance of these assets. Let's say land, plant, machinery, building and all. We'll get their opening, depreciation given, and closing also given. So here the tricky part is we have to get purchase. The difference is like a purchase, we will get purchase, because here if closing is higher than this opening minus depreciation, then how much closing is higher than opening minus depreciation is because of purchase. Because let's say opening is 50, depreciation is 5, but closing is let's say 60. So we, as per our understanding, 50 minus 5, the assets should have been 45, but now it is 60. So it increased to 60 because of depreciation. There is a purchase of asset which is 15. So the difference we will take as purchase 15. But if in a case opening was 50, depreciation is 5 given to us, but now closing asset is, let's say, 40. In our calculation, we have opening 50, depreciation 5. So closing should have been 45. Now it is 40. That means what? 5 rupees worth of asset is sold. This is going to sell of asset. So this equation we will use for figuring out when There is a sale or purchase of asset, but depreciation must have been provided. But there is no depreciation, no purchase sale information. So the difference in the opening and closing balance will be considered as depreciation. That is depreciation we have understood. And also certain cases, similar approach you will be using for amortization, because depreciation is applicable on tangible assets, and amortization is used for intangible assets. Then the fourth item we may consider basically, interest on debentures and loans, because certain cases these are also hidden, but yeah, if the opening and closing debenture and loan figures are differing, then the difference would be issue or repayment of loan. But if it is the closing balance is higher than opening, so we will always say there is a issue of loan or issue of debenture. So in that case, the question would be providing us on which day or which point the debenture was issued. Accordingly, we will calculate interest. On opening balance, we will calculate interest for the whole year, and for the additional issue, we will calculate interest for the period for which it was issued during the year, like from the date of issue till the end of the year. If the debenture is issued on 31st, let's say, 31st, I would say July, 31st July, that is issue date. So now onward, so we have August, September, October, November, December, January, February, March. It is 8 months time. So the debenture is issued for 8 months or outstanding in the year for 8 months. So we will calculate on the additional debenture amount interest, and the opening balance is used in the whole year. So we will calculate interest for the whole year. Total, we will add the interest, we will get total interest. So that is how. But yes, certain cases, if there is no information as to when the debenture is issued, we can safely assume the debenture is issued on the last day of the accounting year, let's say on 31st March. So on additional debenture or loan, it is not having any interest effect. So that is the thing we have to understand. So it is all about interest, how to calculate if it is not given to us. So, and remember, the rate of interest is basically appended to the debenture name, 5% debenture, 10% debenture. Therefore, you get debenture rate of interest, and you search for the date when it is issued, and accordingly you calculate interest. But there is no such information. You can safely assume debenture is issued on the last day. So there is no, interest calculation on the additional amount. But certain cases there is repayment of debenture. In that case, what we see, we can say that if information is provided on this date, let's say it's a debenture was redeemed on 1st of January of the accounting year. So on 1st of January, in the sense, some amount of debenture that is redeemed was not available from January to March. So for 9 months, we will calculate a debenture interest on the whole amount. Let's say debenture was outstanding at the beginning 10 lakhs, and let's say 10 lakh, and we redeemed 2 lakh on 1st Jan. So for 9 months, 10 lakh was outstanding. So we'll calculate interest for 9 months. 2 lakh was redeemed on 1st Jan. So then after 1st Jan, for 3 months, debenture was outstanding 8 lakh. So we will calculate on 8 lakh for 3 months. And then this is interest for 9 months. This is interest for 3 months. We add this, we'll calculate this interest and we'll add, then we'll get total interest. Total interest for the year. And debenture interest would be adjusted in the operating activity because it is a financing activity item, and generally we minus it in the income statement as finance cost. So it is already factored in the profit before tax. So we are nullifying its effect in the operating activity. So we are adding it back. In the operating activity, debenture interest or finance cost is added, and it is an outflow in the financing activity. So we put as outflow minus. So this is about debenture interest or or our loan interest, and then we have extraordinary item, if at all, that also we will deal with. As I explained you, extraordinary items are they are nullified, their effect is nullified in the calculation of working note, which we saw here. Extraordinary item, if their profits, they are less, they are minus, and if their losses, they are added. So their effect is nullified when you arrive at your net profit before tax and extraordinary item. And since they give us cash flow, when we arrive at operating cash flow, their effect also given there. Here we see extraordinary item, added and minus. If it is a profit, it is giving us some abnormal profit. Yeah, for that year, the profit would be with some abnormal item. So we are also disclosing separately how much profit we are getting from abnormal items, abnormal profits. If there's abnormal profit, we are adding, abnormal loss, we are minus. So their effect is given in the operating act. So two places this extraordinary item effect is given. One is before, when you before the calculation of profit before tax, like when you are arriving at profit before tax, to do the working note, there you adjust, and when you also calculate the ultimate cash flow from operating activity, there you give effect of extraordinary items. Now the last item, if I say it is a fifth item, that is provision for taxes. Provision for taxes. As I told, this may be a current liability. This is a short-term provision, short-term liability, certain cases we tend to say, but it is separately dealt. Taxes, it has two treatments. In the calculation of profit before tax and extraordinary item, always the adjustment is of net of refund. So here, when you calculate profit before tax and extraordinary item, this tax provision minus refund. If you separately minus refund, it is okay. Otherwise, you can minus from tax provision. So tax provision minus refund would be added back. This is added to get the profit before tax extraordinary item in the working note, as I shown you there. Profit before tax and extraordinary item, that is when calculated, this tax provision. What is important is we have to mark it is provision. Tax provision for the current year, tax provision for the current year minus refund of income tax, if at all, that will be added to get profit before tax and extraordinary item. There is another place where this tax is dealt with is when we calculate the net cash flow from operating activity. Towards the end, we also minus tax paid. This is tax paid. We have to be very particular. What are the adjustments? So when we calculate net profit before tax and extraordinary item, profit before tax and extraordinary item, that case we adjust for tax provision net of refund. But when we calculate operating cash flow, there we adjust tax paid net of refund. This is what when we calculate operating cash flow. So the two places, tax provision, tax paid, they are differently treated. Now I can show you that here. See, when we are calculating net profit before tax extraordinary item, tax provision of the current year, net of refund, or else you can minus refund separately. That is getting adjusted, and when we are calculating our operating cash flow, there we are minusing, also highlighting in green, this one, less income tax paid net of refund, that we are minusing. So these are the adjustments of tax provision and tax paid. So with the absolute thorough understanding of the format and the typical items, now I can explain you how we will do a question in just 10-15 minutes. See, we have 2 years balance sheet provided, 2022 current financial year, 2021 last financial year. We have been provided with equity liabilities, shareholders fund, non-current liabilities, current liabilities. In assets, we have non-current asset and current assets. And also we have been provided with certain notes to accounts. And notes to accounts explaining as reserve and surplus, long-term borrowings, short-term borrowings, short-term provisions, and then PPE, that is tangible assets, intangible assets, and other current assets. And additional information also provides us about depreciation of the year. There is some assets sold out, and we have made some profit on sale of asset and interest. So these are to be adjusted, and couple of things we have to calculate before we venture into preparing the cash flow statement. Here, since there is no income statement provided to us, so we cannot get any profit before tax and extraordinary item. For that, we may prepare a working note. Generally, I told that there is profit when it goes down from the profit before tax, how it is getting distributed. First is tax, and then dividend and transport reserve, and in your surplus. So the starting point to get is this surplus. So take the difference of surplus. So we have at the last year surplus 1 lakh, current year it is 1,87,000. So here we are getting a difference is out of current year profit 87,500. I'm just telling in rough, so that we can prepare the statement working note to calculate it. So 87,000 is the surplus increase. Other part of the profit after tax goes to the transfer to reserve basically. 50,000 is opening balance of reserve, now 87,500. So that is something like 37,500. These two basically are profit after tax is now these two places they are residing. Profit after tax of the current year is getting placed at these two places, surplus and general reserve. Maybe some dividend distributed in the current year, we will check it, but additional information doesn't mention anything about it. So no interim dividend, nothing it is saying. Let us also check for if any preference share capital is there. There is also no preference share capital. Had it been there, then would have also assumed that yes, some preference dividend is paid, but here there is no preference capital, it is only capital, equity capital. So safely we will assume that entire profit after tax is residing at two places, general reserve and surplus. Taken the difference, and this is how we will add around. If we add, we will be getting 87,500 plus 37,500. This is what 1,25,000. These two giving us 1,25,000. This is the profit after tax. We piece together these two stuff where the profit after tax they are residing. So we got 125,000 is the profit after tax. We want profit before tax and extraordinary item. So we have to add tax provision. Tax provision. So tax provision for the current year, that information will be getting from the information supplied to us. See, we have in the notes to accounts short-term provision, there is a tax provision, and it was opening 1 lakh, closing is 1,25,000. So these are not tax provision. This is not like we will read it as 1 lakh was the last year tax provision and 1,25,000 is the current year tax provision. That is not the case. They are opening balance of tax provision is 1 lakh, closing balance of tax provision is 1,28,000. What is the relationship between them? This is how they are having relationship with each other. The equation is opening tax provision plus current year tax provision, how much current year tax is provided during the year, okay, minus tax paid equal to closing tax provision. This is the equation. Or because we want these two things. What is the current year tax provision, which we adjust while calculating profit before tax? This is used for calculating profit before tax and extraordinary item, and the other one, tax paid, which we also use, this tax paid used for calculating operating cash flow. So these two, so therefore we need to know this. So opening tax provision plus current year tax provision minus tax paid equal to closing. But when we have this opening tax provision is equal with the, sorry, when opening tax provision and closing tax provision, they are provided and no other information is provided to us. So here we will be considering how our opening was 1 lakh and closing is, sorry, closing is 1,25,000. There is a difference. So here we will assume that there is no information about, if you look at, there is no such information about how much tax is paid during the year. Yeah, so no taxes, no information about how much tax paid or things like that is provided to us. So we can say that opening was 1 lakh and closing is 1,25,000, and there is an increase from 1 lakh to 1,25,000, maybe because if you minus tax paid, so 1 lakh would reduce maybe less than something or less than 1 lakh, but it is increasing to 125. So we may assume that 25,000 is the current year tax provision. So it is therefore becoming 125. That means what? From the last year, we have 1 lakh tax to pay, and current year it is 1,25,000. So current year tax provision is 25,000. That means no tax is paid during the year. That certain cases is little illogical, because without payment of tax we cannot do business. Anyhow, we have to pay the tax. So some tax we have paid during the year. That is how this is not like exactly the relationship which we are trying to see, that 1 lakh was opening, 25,000 was increase in the tax provision during the year as a current year tax provision, and closing is 125, it is become. So that is little illogical, because if you assume like this, we do not have any tax paid. So in that case, it sounds to be little illogical. So in that case, what is the logical assumption? We will assume it like that out of the opening and closing, opening balance, which was the tax at the last year end, this 1 lakh, which are closing opening balance of the tax provision, that opening balance is paid during the year. This particular tax is paid during the year. And what is we are having as closing balance of tax provision, that is this 125, but its closing balance we are having, That is current year tax provision. So now if you see the equation with this assumption, opening was 1 lakh plus 125 current year tax provision. Okay, 1 lakh plus 1 lakh 25 minus tax paid is again opening balance is paid 1 lakh. So obviously we'll be having 125. That is little logically sounding. But the other one, if you try to put 1 lakh plus 25 equal to 125 with no tax paid, that is little illogical because we cannot do business without paying tax. The moment when we have our income calculated, so we have to pay the tax due, before the due date of filing return, we have to pay the tax first and then file the income tax return. So the tax must have been paid. So here the 1 lakh, which is the tax for the last year, must have been paid in the current year. So 1 lakh is the tax paid. 125, what we have as a closing balance, that is the current year provision. That is a logical assumption. So this particular assumption is bad when there is no other information, only opening provision tax given, closing provision tax given. But certain cases, if we have, let's say, tax paid is given to us. Let's say opening was 50. What is current provision is not given. So current provision, let's say X, tax paid is given, let's say 40, and closing provision is, let's say 70. From here we can get how much is, this is paid and this is provision of the current year. So this we can now get, but three things are given to us. One is opening provision, closing provision, how much tax is paid. When 3 is provided, we can simply put the equation, we can get the provision for current year. But certain cases, if provision is given, we have to arrive at the how much is paid, that was missing, that may be missing there. So if let's say 50 is opening and then there is some tax provision is, let's say 40 or so tax provision the current year, but how much is paid is not there, it is missing. So that we'll take as X, and let's say closing provision is 70. So this we will get X, how much is the current year tax paid. So when three things are given, opening, closing, or any one of the tax provision are paid. If tax provision is given, we will arrive at tax paid. Tax paid is given, we will arrive at tax provision. Tax provision is given, we will arrive at the tax paid. So when three things are given, one we can get out of the equation. But yes, when three are not given, only two are given, that is in the schedule. So we have to assume that opening is paid and closing is the current year provision which is outstanding at the end. That is what the assumption. So here our profit before tax and extraordinary item would be, we got PAT as this 1,25,000, which I just added this transfer to reserve and surplus change 125, and we earned profit before tax and extraordinary item. So we have to add back also the tax provision of the current year, and which we assumed here tax provision of the current year is the current year closing balance of the tax provision is the current year tax provision only, because opening is given, closing is given, there is no other information. So we'll assume opening is paid and closing balance is the current year tax provision. So this 125,000 is the current year tax provision. So profit before tax and extraordinary item would be just these two reserves we add, plus this is tax provision of the current year, this is profit before tax and extraordinary item, assuming there is no extraordinary item here, no information about extraordinary item, so that is nil. Then we will adjust for non-cash, non-operating item, which I told you, those items which are non-cash, non-operating, they are minus the income statement, they have to be added. Those items which are non-cash, non-operating added in the income statement, they will be. And what are the things? Non-cash, non-operating, basically depreciation is one. Then from financing activity, we are getting interest, and dividend is already, because we are taking before tax profit. So dividend must not have been minus from before tax profit. Only interest must have been minus. So interest we will minus, and there is a brand written off. Brand written off, we have to see if there is any brand, there is a change in figure. Like as I told, when there is a change in opening and closing because of opening and closing, in the sense closing is less than opening in case of fixed asset, it can be a depreciation or amortization in case of intangible asset. If there is no other information given, see here, in case of intangible asset, There is a brand intangible asset. Opening balance was 37,500. Closing balance is 25. There is no purchase, no sale, nothing. So obviously, the change we will attribute to its amortization or depreciation. In case of intangible asset, we call it as amortization. So around 12,500, that is fall in the value of the brand, is amortization or writing off of this brand. So this is a loss like depreciation. We add it back. Interest paid also to be added back. Then we'll check for any other thing. So as a part of standard add, we have non-cash, non-operating like depreciation and then interest expense. These two generally are added, and if at all there is any loss on the sale of asset, that is also a non-cash, non-operating item to be added. So three things to be added generally: depreciation, amortization, interest, which is a finance and financing activity item, and loss in sale of asset. These are three to be added there because there are losses or expenses. And what is to be minused? Basically gains and profits are to be or incomes to be minus, because originally they are added in the income statement. For example, basically our investing incomes are interest, dividend, and rental income on investments. Number one, these are investing activity income. They are added in income statement. Now we are nullifying the effect in the operating activity, plus gain on sale of asset, that also to be added because that is a gain which pertains to investing activity. You gain on sale of assets, so that you also nullify. So here we do not have, if you see here, there is no such income pertaining to the investment. No additional information, because it is only balance sheet given. Balance sheet means asset, liability, and equity must have been provided in balance sheet and notes, and any income and all they must have been given in the additional information here. But no such additional information. And again, if you're checking the balance sheet, there is no financial assets or other assets. Only the non-current asset part, we have property, plant, equipment, intangible assets. There is no financial assets giving rise to financial income like interest or dividend. So no such income. So only one income is this: gain on sale of building, a land and building, that is an income which you will minus. So gain will be minused out. You get operating profit before working capital changes. Then we will be adjusting for working capital changes. So working capital, if you check our balance sheet, working capital are basically current assets and current liability. In the current asset, we have inventories, trade receivable, cash and cash equivalent. We are not considering other current asset. Let's see what is there. Other current assets, we have only prepaid expenses. Okay, so we have like inventories, trade receivable, cash equivalent will not consider. Other current asset is prepaid expense. So these three assets we have. Liabilities, we have short-term borrowings, trade payables. That is a note to short-term borrowings. We'll see trade payable is a current liability, and short-term provision, probably this is represented by tax. So tax is dealt separately, so this is not to be treated like a current liability. And short-term borrowings, we have OD and cash credit. OD, cash credit is a is a loan. We can consider it as a loan, sources of finance, but OD I consider it is a negative bank balance. But certain cases, some author they consider as a sources of fund or financing activity item. So this can be considered as financing activity item. If that is a case, then they are not current liabilities. They are not, because they are financing activity. They are sources of financing activity item. They are not current liability. So in the current, as a current liability, we will consider only trade payable, because short-term borrowing, they are cash credit and OD, so they are financing activity item we are treating. The author has treated here, and short-term provision is the tax provision, which you have already very particularly and very separately we have treated them. One is while calculating profit before tax, and other one while we will be also giving the effect tax paid towards the end of the calculation of operating activity cash flow. So only current liabilities, trade payable. So we have inventory, trade receivable, and prepaid expenses current asset, and trade payable current liability. So we will see what is the effect, how they are changing. If let's say current liability we are taking, it is trade payable 1 lakh what is beginning, 75 and the end, the closing balance. So that is 75,000, which is 75. Here that is increase. So increase in current liability will be added. So this will be adding effect. Inventory is 137 to 50. There is a increase in inventory. The increase in current asset will be minus. Here also increase in trade receivable, increase in current asset will be minus. And prepaid expenses is decreasing. This will be all in current asset to be added. So these are the four effects we are seeing from current asset and current liability as a form of our working capital changes. See, trade payable added, prepaid expenses also added, inventory and trade receivable minus. So once we adjust working capital changes, we'll get net cash inflow from operating activity, or we can say it is operating profit before tax, and extraordinary item, or net cash flow from operating activity before tax. Since we do not have any extraordinary item, simply once we adjust for tax, we will get operating cash flow. So here, once we got after adjustment of working capital, only one adjustment is the tax paid, and that we have to be mindful of. Here, the tax provision would not be minus out, tax paid. And as I told here, there is no opening provision, closing provision. So no other information about tax provision of the current year or tax paid in the current year. So simply we will assume that opening provision is paid in the current year and closing provision is outstanding as closing balance of the tax provision. So we added the closing balance of the tax provision as current year tax provision in the calculation of profit before tax, and opening tax provision is the last year tax provision which is assumed to be paid during the current year. That was 1 lakh opening provision. You see, it was opening provision of tax was 1 lakh here. 1 lakh is paid. That is minus here. So we get operating cash flow. Here it is positive 77,500. Then we will be seeing cash flow from investing activity. And when we calculate investing activity, by and large, I told you investing activity generally relates to non-current asset part. Very simple, non-current assets, yes. So here we have two non-current assets only. One is PPE, property, plant and equipment, or the one is intangible assets. So they have also notes. Let's see what is that non-current asset. So non-current asset, we have land and building, other one is machinery. And there is a branch, that is intangible asset. See, in the branch, there is no sale, purchase, nothing. It is said about branch. So we assume the decrease in the non-current asset of which is intangible character as amortization. There is a depreciation, so there is no purchase sale with regard to intangible asset. Now we will see with regard to tangible non-current asset, there is land and building and machinery. So yes, depreciation already we have considered. Depreciation was only on machinery 27,500. Depreciation during the year 27,500 on the machinery, and there is a gain on the land and building, it is saying. So let us figure out how much is the sale or purchase in the land and building case. So now there is additional information says there is a gain on the sale of land. So we have sold some land and the gain is 50,000. Quite simple, common sense we apply. Opening land building was 6,50,000. Now closing land building is 3,50,000. So that is a change from 6,50,000 became 3,50,000. Some 3 lakh we have sold. 3 lakh. But we made some gain of 50,000. So our land building cost was 650. Now the cost at the end was 350. So 3 lakh is sold out. 3 lakh worth of land, 3 lakh cost of land is sold out. But now we made a profit of 50K. So 0.5 lakh excess we got by selling the land over their cost. So we made a profit 50K. So therefore, maybe the selling price which we have got is 3.5 lakh. So land and building of 3.5 lakh, like of cash we have generated on land and building basically. So 3 lakh is actually sold out, cost of land, and at excess price of 0.5 lakh, which is 50,000, we got 3.5 lakh. And that must have been the flow. Here, you can do it on working note or account even. But yes, simply I can calculate here. Just simply opening balance was 6,50,000 minus closing balance 3,50,000. So this is the cost of the land, and building which are sold out, but they are sold out at a profit. So we are adding, if they are sold out at a loss, then we'll be minusing. But here they sold out at a profit. So whatever cost of the land which we sold out, excess we realize 50,000. So that is what we realize. 3,50,000 we have realized. Very simple. This you can use. And there is no depreciation. You just mark there is no depreciation on land and building. But had there been depreciation in land and building, then we have to again use depreciation while calculating the operating cash flow. Like depreciation we have taken here only for the machinery part. Depreciation, it has told machinery is only subject to depreciation. So this 27,000 we have taken on machinery. No such depreciation land and building. So straight away we take in the difference in the opening balance, closing balance is the cost of the land which is sold out. But yes, they are sold out at a profit 50,000. So excess cash which we realize over the cost is 50,000. So entire cash flow is 3,50,000. Now we will see very simply how much we have realized from the machinery, because machinery balance also not same. That is also depreciation. Then I told you the equation which we use here for the asset when there is a depreciation is, remember I told you just when we started discussing about special items, opening minus depreciation plus purchase minus sell equal to our closing. So how much worth of assets we have purchased, how much worth of asset we have sold, on depreciation given, if opening closing given. So if like there are 5 items, any 4 given, 1 is missing, we can calculate. Generally, if depreciation given and purchase of the assets given, but still opening minus depreciation plus purchase is not equal to closing, then the difference will be sell. Or opening depreciation sell is given and closing given, but opening minus depreciation minus sell is not equal to closing, then the difference is the purchase. Now same equation we'll put here. So opening we have 2,75,000. Then depreciation is 27,500. And we are having closing balance, 2,70,000 closing balance, 7,25,000. This is exactly. So 725. So opening balance minus depreciation should have been our closing balance. If nothing is happening, no purchase, no sale. But yes, it is not the case. Opening minus depreciation is not closing. So that is something happened to machinery, buy or sell. But yes, it is not sell certainly, because had it been sell, opening balance minus depreciation, the closing you will be getting must have been less than these two difference. But here it is increasing. Opening balance minus depreciation, whatever you are getting, the closing balance is higher of them. So something you have purchased. So what is the purchase then? Simply we can calculate it like from 7,25,000, we will take the opening balance minus depreciation, the difference. 2,75,000, it was the opening balance, 27,500 is the depreciation. This should have been the closing, but this is not the case. The closing balance is something different. It is something like 725, 7,25,000. Difference is coming 4,77,500. This much worth of assets are purchased during the year, 4,77,500. Maybe the answer is calculated by preparing ledger accounts. But yes, this can be also very commonsensically calculated, which by using this equation, opening balance minus depreciation plus purchase minus sale equal to closing. Here there is no sale because sale would be minus. There is no sale because it is increasing. The closing balance is increasing, must have in their purchase. So we'll get the purchase of the asset, which is negative. You see, 4,77,500. So this is investing activity. Net cash flow is 127,500, which is negative. So we will write it like our cash used in investing activities 1,27,500. Then financing. Simply financing, we tend to check with equity and non-current liability. See, equity, when we check equity, basically we take the capital. So see, capital was 5 lakh at the beginning and also 5 lakh, no change, no fresh capital issue. That is clear. Reserve, we do not take because reserve, it comes from basically profit. So we consider changes in reserve and surpluses belong to operating activity. So shareholders fund, absolutely no effect on financing activity. Then we will see non-current liabilities, that is the borrowing. So that is a note because notes given, detail is given, check the details. So checking details, we will see there is a 10% debenture, there is a this mortgage loan. Yeah. So here there is a change in debenture. Change in debenture 2,50,000 and 3,75,000. See, that is increase around 125,000. But yes, we'll check. Debenture carry interest. As I told you, when debenture issued middle of the year, obviously we have to calculate interest on opening balance for the full year. And when the new issue happened in middle of the year for the period for which the debenture was outstanding, new issue was outstanding during the year. So that interest will calculate and add to the interest on opening balance. But here the point is the date on which the new issue happened is not given to us. There is an increase in the debenture balance. 250 was there and 375. So there is a 125,000 increase. But when that in 125 has increased, that is not given to us. Safely we can assume that the increase is at the end of the year. So the interest effect is zero of the additional debenture. Only the opening debenture would be carrying full interest for whole year. 2,50,000, 10% is 25,000, which we have adjusted in the operating activity. Interest expense. Interest expense here paid is it is calculated as interest paid 60,500. Interest paid is given to us. That is given. That I missed. Interest paid is given to us. But yes, if that was not given to us, so safely we could have assumed from the information where here 10% debenture, the 125 had it been not given, 125,000 is issued at the end of the year, so there is no interest effect of the same. But yes, 125,000 is increase in the debenture happened, so that is an inflow. But interest effect, we may assume there is no interest effect, assuming it is end of the year. If it is issued, no information about when it is issued. But yes, it is here giving us after calculating the total interest. So there is no worry for us. We will take that fee only. So there is interest 60,500. Yeah. And that interest is an outflow in the financing activity. That you see, interest on issue or interest on debenture 60,500 outflow. And there is an increase in the debenture, which must have been arising from issue of debenture, this 125. Now, there are no other, I think, mortgage loan also not changed. 225 and 225 remain same, but as we have considered short-term borrowings, this bank OD and cash credit, they are sources of finance, they are financing activity item. There also changes we will consider as generation fund or repayment of cash or repayment of cash or taking off cash. So here opening balance of the OD was 25, now 55. That is a 30,000, 30K change. So this 30K, we have taken additional fund, additional money. It is inflow of cash 25 to 55, 30K. Then that is also 25 to 20 cash credit reduced. So that is a 5K for repayment of cash. So 30K is a positive inflow and this is negative outflow of cash and cash equivalent. So now this simply you see the adjustment. Process from bank OD, it is positive 30K and repayment of cash credit 5K. So this is all your financing activity item. Add them all, we get net cash flow from financing activity is 87,500. So with this financing activity calculation, we got the three activity net cash flows, three activity. From operating activity, it is a cash flow 77,500, which we named as activity A, and the cash flow here I'm mentioning A. Then investing activity, this is activity number B, and the cash flow also I'm mentioning as B. And then financing activity, we have positive cash flow 87,500, the activity named as C, so cash flow also I'm putting as C to for these three. So A, B, C, three activities, three cash flows. So we can add them all. A activities cash flow, B activities cash flow, C activities cash flow. 77,500 minus 127,500 plus 87,500. We will get the net change in cash or cash equivalent, which is nothing but sum of the three activities cash flow. We will get 37,500. This is the net change in the cash equivalent from three activities. Then the finishing touch is the net change in cash and cash equivalent. You add to the opening balance of cash and cash equivalent. Opening balance of cash and cash equivalent was 1 lakh, which we will get also from the balance sheet. So the balance sheet, if you refer our cash and cash equivalent here, it was 1 lakh in the current asset, because OD cash credit, they are not in the asset, they are in the liability, so they are not going to affect. So cash and cash equivalent basically are assets, current assets. So 1 lakh it was at the beginning. The change happened during the year is 37,500. So 37,500 added with the opening balance of cash and cash equivalent 1 lakh. Naturally, the closing balance should have been 1,37,500. Let us check this 1,37,500 at the end or not. So if you check it, we will find also the same figure. See, our cash and cash equivalent at the end is 1,37,500, which matches, must be matching, because that is the rule. Opening balance of the cash equivalent plus net change in the cash equivalent during the year from three activities, we get the closing balance of cash and cash equivalent in this particular case, which is exactly the same. So now, this is how we have understood the entire story of cash flow statement, understanding of its format. This very format we have understood thoroughly, and also we have done an illustration to solidify and cement our understanding. And these two working notes which are there prepared in form of ledger to get the sale of land and building value, and machinery account also here, that we prepare just very commonsensically. How much of machinery was purchased. These two figures are prepared in in terms of ledger accounts, but we have calculated very commonsensically, mathematically, that any approach you feel like comfortable, you can follow. So with this, I have thoroughly explained how to prepare the cash flow statement and a very comprehensive understanding of the cash flow statement formats and very important items there, important special items there. So thank you all for listening to this very important discussion and sparing your valuable time. And thanks for the Pride Edukov. Bye.